start. Here is your fair value gap. This is what you're used to seeing. This is how I teach it to you, okay? Algorithms, high frequency trading algorithms, will take that inefficiency there and bust it up into quadrants, okay? And I'm going to show you how I was able to talk about Thursday's trading when the GDP number came out and how I knew where it was going to go and all that business. I was looking at this gap here, and this is the anatomy of the fair value gap. That entire range, you put it in quarters. So there's a quadrant from the highest to here, midpoint, lower third, low. Those levels, if we take those levels and add them to the hourly chart, watching the live stream on Thursday morning when you heard me talking about with my son, the low here, the fair value gap here was at the low end of what? The high, upper quarter, midpoint, lower quarter, low of that daily fair value gap. Look where that fair value gap 60-minute resides, right at that lower quadrant. I only want to see it trade up into that. I don't want to see it go above the halfway point, because if it does, that means it's probably not as bearish as I want it to be. So the best short positions are going to occur at the midpoint of that gap on the daily chart, which is that dashed line, and the low. So it goes up to the upper quadrant, and it's the 60-minute fair value gap. High frequency trading algorithms are going to trade that right there. And market drops lower. This idea, you're going to couple that with what I've been teaching about how when prices don't reach to a specific level and fail, it indicates exceedingly bearish or exceedingly bullish. And I'll teach more about that this week. I'm also going to teach you more about new week opening gaps in a very specific lesson in entirety by itself. It's nothing else but just that. Okay, so that'll be on Wednesday. And on the 15-minute time frame, you can see it here. So it runs up, hits that lower quadrant level of that fair value gap on the daily chart, and the premium 60-minute fair value gap, which doesn't look like a fair value gap now when we look at it on the 15. It's important to move from the top down, higher time frame, lower time frame. More specifically, here is that higher high that's formed in between these two time periods, these vertical lines. Look at that. The S&P made higher highs there into the area I was drawing your attention to, and it's the lower quadrant on that daily fair value gap. And at the same time, the dollar index was unwilling to do what? Make a lower low. See that? So that's SMT. USDX dollar index. SMT. It should have made a lower low there. It didn't. So when it does these things, that is what? That's flashing like the beacon saying, okay, smart money's going to go short here. And what's it going to aim for? Sell side. Why? Because it took the buy stops above here. So if they're going to buy, if they're going to sell short to the buy stops here, what are they going to look for to get out? Sell stops. Where's the market go? Right there. And then what does it do? Right back up to the fair value gap on the daily chart. Bounces there, hits it here, new week opening gap. Go and look at Twitter. You got to watch Twitter. Goes into new week opening gap, and then does what? It goes lower, obviously. And zoomed in on a 5-minute chart. There's the details again. Beautiful higher high into a level I was calling. And there's the SMT divergence telling you it's going to drop.